It was supposed to be a show of force. Early one morning, Donald Trump announced that tariffs on Canadian aluminum and steel would jump from 25% to 50%. The message was blunt, public, and unmistakable. Canada would be pressured into submission. The United States, as the buyer, would dictate the terms. Markets, allies, and industries were expected to fall in line. Instead, everything unraveled. Within minutes, uncertainty rippled through financial markets. Aluminum prices surged, manufacturing stocks slid, supply chain risk was repriced in real time. The Dow Jones dropped sharply, not because Canada blinked, but because investors did. 6 hours later, the escalation vanished. The 50% tariff was withdrawn before it ever took effect. The White House scrambled to reframe the retreat as a negotiated win, pointing to vague talks and an electricity-related concession that had never actually materialized. But the truth was visible to anyone paying attention. The threat had failed. The weapon could not be used. In just 6 hours, the United States revealed something far more damaging than policy inconsistency. It revealed that its leverage in the aluminum trade was largely imagined. This was not a tactical pause, it was a structural exposure, and it raised a question far more serious than any single tariff decision. What happens when a country declares economic war without understanding who actually depends on whom? The foundation of the failure lies in a fact that was either ignored or misunderstood. The United States is not marginally reliant on Canadian aluminum, it is structurally dependent on it. In 2024, Canada supplied approximately 52% of all primary aluminum imports into the United States, more than half. This was not a matter of preference or pricing convenience. It was the result of decades of industrial erosion inside the U.S., where domestic aluminum smelting capacity collapsed under high energy costs and underinvestment. Canada filled the vacuum. Quebec alone accounts for nearly 90% of Canadian aluminum production, anchored by massive smelters operated by global giants such as Rio Tinto and Alcoa. These facilities produce over 3 million metric tons of aluminum annually, placing Canada among the top aluminum producers worldwide. But volume is only part of the story. Canadian aluminum is produced almost entirely using hydroelectric power. That gives it one of the lowest carbon footprints of any major aluminum producer on the planet. This is not a branding detail. It is a competitive advantage with long-term consequences, especially as global markets begin to price carbon more aggressively. Trump's strategy treated dependence as leverage. He assumed that because the United States was the buyer, it held the power to coerce. But in commodity markets, especially global ones, buyers without alternatives are not powerful. They're vulnerable. Aluminum was never a pressure point for Canada. It was a pressure point for the United States. Once the decision was made, the unraveling followed a predictable but devastating pattern. In early 2025, the United States reinstated a 25% tariff on aluminum imports, invoking national security justifications that were never clearly defined. The real objective was transparent: apply pressure on Canada within a broader trade confrontation. The assumption was simple: Canada would absorb the shock and negotiate. Instead, Canada responded with discipline. Ottawa announced targeted retaliation: 25% tariffs on roughly $30 billion worth of American goods, with an additional $125 billion in measures prepared for rapid deployment. The message was calibrated, not emotional. Escalation would be met, but not theatrically. Then came the moment that exposed the imbalance. Ontario's premier publicly stated that the province was considering a surcharge on electricity exports to the United States. No policy was enacted, no timeline was announced. It was merely a signal. Yet that signal struck directly at U.S. states, Michigan, Minnesota, New York, that depend on Canadian hydroelectric power to stabilize their grids. The response from Washington was immediate and uncontrolled. Within hours, the White House announced that aluminum tariffs on Canada would double to 50%. The move was reactive, not strategic. Markets recognized it instantly. Equity indices fell, volatility spiked, and industrial investors began modeling worst-case supply disruptions. And just as quickly as the threat appeared, it disappeared. 6 hours later, the 50% tariff was withdrawn. Officials described the reversal as diplomacy at work, but no concession had actually been secured. The electricity surcharge had never been implemented. Canada had not retreated. The episode confirmed what markets already understood. The United States had threatened a weapon it could not afford to use, revealed its vulnerability, and retreated before the consequences fully arrived. While political attention in Washington fixated on optics and messaging, Canadian aluminum producers were already executing a fundamentally different strategy. They were leaving. For decades, the United States had been the dominant destination for Canadian aluminum. Logistics were efficient, supply chains were deeply integrated. In early 2025, roughly 95% of Quebec's aluminum exports flowed south. That changed almost overnight. As tariffs destabilized pricing and introduced political risk, Canadian producers began redirecting shipments to Europe. By the second quarter of 2025, U.S. market share fell to approximately 78%. Europe's share surged to nearly 18%. This was not a marginal adjustment. It was a structural reallocation. Alcoa alone diverted more than 100,000 metric tons of aluminum away from American buyers within a single quarter. Rio Tinto's Alouette smelter shifted from sending just 4% of its output to Europe to more than half. Countries that had rarely imported Canadian aluminum, Italy, the Netherlands, Poland, Germany, Spain, suddenly became regular recipients. This pivot did not require new relationships. Canadian producers already operated within European networks. They had smelters in Iceland, Norway, and Spain. Distribution channels existed. The tariffs simply changed the profit calculus. As one industry leader put it plainly, when prices are better in Europe, aluminum ships to Europe. Trump's tariffs made Europe more attractive than the United States. Canada followed the market. What began as a tactical redirection quickly evolved into a strategic realignment. Europe was not merely absorbing Canadian aluminum as a short-term substitute for American demand. It was actively prioritizing it. The reason was structural, not political. Beginning in 2026, the European Union's Carbon Border Adjustment Mechanism will impose a carbon cost on energy-intensive imports, including aluminum. Under this regime, aluminum produced with coal-fired electricity will face substantial price penalties. Canadian aluminum, powered primarily by hydroelectricity, carries a carbon intensity far below global averages. This difference is not incremental, it is decisive. European buyers understand the math. Over the coming decade, low-carbon aluminum will not just be cheaper, it will be viable, while high-carbon supply risks being priced out of the market entirely. Canadian producers recognized this earlier than most and moved accordingly. They began branding and marketing their output as green aluminum, not as a slogan, but as a contractual advantage. Multi-year supply agreements were signed with European automotive manufacturers, aerospace firms, and construction conglomerates. Logistics infrastructure was upgraded, shipping routes were optimized, volumes were locked in. The Canada-European Union trade agreement had already eliminated tariffs on most Canadian goods entering Europe. Trump's tariffs accelerated what that agreement made possible. In trying to punish Canada, the United States pushed its primary aluminum supplier into a market that values exactly what Canada produces and is prepared to pay for it over the long term. The aluminum dispute revealed something even more uncomfortable for Washington.
Ontario's threat to impose a surcharge on electricity exports was never implemented. It was never codified. It existed only as a public consideration. And yet it was enough to force a retreat. That alone revealed where leverage truly resided.
Several U.S. states rely on Canadian hydroelectric power to stabilize their electricity grids. Interruptions or price shocks would have had immediate consequences for households, manufacturers, and utilities. Unlike aluminum tariffs, which diffused costs slowly through supply chains, electricity disruptions are immediate and politically explosive. Canada did not need to pull the trigger. The mere possibility of the action caused Washington to panic. Compare that restraint with the American response. Tariffs were imposed, escalated, reversed, and defended, all within hours. One side demonstrated control through restraint. The other revealed weakness through overreaction. This was not simply better tactics, it was superior leverage management. Canada threatened an option it did not need to use. The United States used an option it could not sustain. By the time the tariffs stabilized back at 25%, the damage had already become irreversible. Canadian aluminum producers had invested hundreds of millions of dollars into European logistics, contracts, and partnerships. Long-term supply agreements were signed, market share was secured, trust was built. These relationships will not unwind simply because tariffs are lowered or removed. American manufacturers, meanwhile, absorbed higher costs, faced supply uncertainty, and lost competitive ground. Automotive producers struggled with disrupted aluminum inputs. Construction projects faced budget overruns and delays. Consumer goods manufacturers passed costs downstream or sacrificed margins. Even companies that continued sourcing Canadian aluminum began preparing for future instability. Redundancy replaced efficiency. Integration gave way to fragmentation. Trump's aluminum strategy failed because it misunderstood the nature of modern economic power. In global commodity markets, leverage belongs to those with alternatives, predictability, and patience, not those who escalate fastest. The 6-hour tariff reversal was not a moment of flexibility. It was a public admission that the United States had misread the balance of dependence. Canada did not win by confrontation. It won by understanding the system better than its opponent.